Views regarding the economy, securities markets, or other specialized areas, like all predictors of future events, cannot be guaranteed to be accurate and may result in economic loss to the investor. Past performance is no guarantee of future performance. Any information is for illustrative purposes only and is not intended to serve as investment advice or as a recommendation, since the availability and effectiveness of any strategy is dependent upon your individual facts and circumstances. Individual securities discussed may be held in accounts where JGUA and or its employees have a beneficial interest. And with that, let's get to this week's episode.
Hey everybody, Dr. B here with John G. Ullman and Associates. This is our weekly market update for the week of April 21st. Thank you for joining us this week. Don't forget to like and subscribe if you find these videos helpful. And don't forget to check out some of the other great content we have here on the page. So with that said, as usual, my goal is to use my background in economics to help you better understand the economy and the financial markets so you can make informed financial decisions. So with that said, let's get ready to hit the books and get up to speed on the markets. So as we usually do, let's start by taking a look back at last week. So of course, tariffs have been a big topic. Last week was actually relatively quiet as far as discussions around tariffs. We did see the Trump administration clarify the fact that consumer electronics, such as laptops and phones, are not included in the 145% tariff on Chinese goods, but will be included in a separate tariff bucket, most likely related to semiconductors. Along those same lines, we also saw the Trump administration mention that there are more tariffs to come, including tariffs on pharmaceuticals and formal tariffs on the semiconductor bucket itself. Taking a look at our economic data for last week, we saw retail sales data, and we saw retail sales increase by 1.4%. Although this came with some caveats, there were a lot of suggestions that this is most likely tariff pre-buying. So folks that would have spent the money later on in the year have instead moved their purchase forwards to try to beat the tariffs. And it's possible that the result of this may be much worse retail sales in subsequent months moving forwards. We also saw industrial production scaled down just a little bit, although the results across different sectors were mixed, with some growth and some contraction. And we saw business inventories essentially flat in spite of the increased retail sales. Taking a look at the job market, we see the job market, as far as weekly unemployment insurance claims are concerned, continues to be relatively strong. The new initial claims came in about 10,000 lower than the previous month, but still within the tight 210 to 225,000 range that we've seen since the beginning of the year. Continuing claims came in at about 1.9 million, which continues to be elevated, but again, within the reasonable range and what we've observed over the last few months. Most likely what we're seeing is a labor market that has adopted a wait-and-see approach, like so many other parts of the economy. Ultimately, the low-fire, low-hire environment continues to persist, where less people are losing jobs, but those that have lost jobs are struggling to find new ones. Last week, we also saw two important manufacturing surveys coming out of the New York and Philadelphia Federal Reserve banks. Both, unfortunately, show worsening current conditions in manufacturing and growing pessimism about future conditions. The Philadelphia survey actually showed the fourth largest drop in the history of the survey, behind only drops in 2020 and 2008. The Philadelphia Current Activity Index is actually at the lowest level it's been since April of 2023, and the New York Future Activity Index actually dropped to its second lowest level in the history of the survey. Both surveys also provided a little bit of insight into the future impact of the new tariffs that have been introduced. Both surveys saw their new orders index hit the lowest level since 2020, and both surveys saw their input cost or prices paid index reach the highest level since 2022. Taking a look at first quarter 2025 earnings reports. The first couple weeks of earnings season, we always see the financial sector reporting. And in this iteration of the earnings season, we saw nearly every major financial institution related to stock trading or equities trading post higher than expected profits and post record revenues related to trading activity. This is a good reminder that institutions who benefit from volatility and the volume of trading don't necessarily depend on whether the market's going up or down. If they take a cut from each trade, they essentially profit from more trades occurring. In some other big earnings news, we also saw United Health Group post a miss as far as earnings and a significantly reduced guidance for 2025. And the market immediately responded with a historic drop in the United Health Group stock price, approaching 22% drop in price at one point. We also saw Johnson & Johnson post strong first quarter earnings results, and Netflix also post strong first quarter earnings results. Netflix also provided strong 2025 forward guidance. I guess the assumption is that if the economy slows down, people will be engaging in a lot of digital and video entertainment. Johnson & Johnson in their earnings report also mentioned growing concern as far as their costs increasing related to the growing import tariffs. Moving our attention to the stock market, unfortunately, it was a down week for all three major stock indices, although each index had its own unique story to tell. The S&P 500 was down about 1.5% for the week, although the story with the S&P 500 had a lot to do with a big drop on Wednesday following comments made by Fed Chairperson Jerome Powell, indicating that the Fed will continue their wait-and-see approach with a slow pace of interest rate reductions and a growing concern for the inflationary impact and the potential economic slowdown that could result from Trump tariffs. At the same time, we saw the Dow Jones Industrial Average lose about 2.7% for the week, although the bulk of that loss came from the United Health Group's price drop related to their poor earnings report, and the fact that United Health Group happens to be the single largest weighted stock of the 30 stocks included in the Dow Jones Industrial Average. The Nasdaq also reported a drop of about 2.6% for the week, although the Nasdaq struggled in large part because of an announcement by NVIDIA that new and unexpected export controls on semiconductors to China would have a approximately $5.5 billion negative impact on NVIDIA's earnings for Q1. Taking a look at some of the other markets that we watch on a regular basis, the yield on the 10-year Treasury fell throughout most of the week, and prices rose as the 10-year Treasury returned to its traditional role as a typical safe haven and alternative to the volatile equity markets. The market for Bitcoin and cryptocurrency in general was unusually stable throughout the week. We saw the price of Bitcoin fluctuate slightly, but ultimately end the week around 85,000, which was approximately where it had started. Additionally, crude oil had a great week, saw price rising significantly, in large part due to two major developments. The first being the Chinese government expressing a willingness to negotiate with the United States in regards to their ongoing trade war. The second being increasing sanctions from the United States, blocking the export and supply of oil from Iran. Unfortunately, the US dollar continued to struggle and remained near its lowest level since 2022. Although gold, in its traditional role as a safe haven and a location for investors who are worried about ongoing volatility, saw huge price increases and actually broke the $3,370 mark, which continues to add increased prices in relation to what we saw in the first quarter as we move through the first month of the second quarter. Moving our attention to this week, as we've moved into the first quarter of 2025 earnings season, a huge chunk of S&P 500 companies, approximately 120 of them, will actually be reporting their earnings throughout this week. Some of the heavy hitters headlining this week's list are Tesla, Amazon, Google, Procter & Gamble, NextEra Energy, and PepsiCo. Also coming out this week, we'll see earnings reports from some major industrial players, including GE Aerospace, the RTX Corporation, Lockheed Martin, and Northrop Grumman, all of which have major contracts with the U.S. federal government, and earnings reports, as well as the discussion after their earnings, may actually provide some insight on the impact that the Department of Government Efficiency and Elon Musk's teams are having on government contracts and large industrial companies. As far as economic data for the week, we'll see the leading economic indicators index published by the Conference Board. We'll see data on new and existing home sales, and we'll see manufacturing data on durable goods. In addition to these important economic reports, we'll also see the final data for the April Consumer Sentiment Report. Consumer sentiment, as you know, has been worsening over the last few months. So the big question in this final data is how much has the sentiment worsened, and are we starting to see either an acceleration of concern or possibly a slowing of growing concern surrounding inflation, unemployment, and the future of the economy. Turning our attention to the future, the big question continues to be, will the fear and uncertainty that we're seeing in the soft data, consumer and investor surveys, translate into the hard data, the actual unemployment, inflation, and GDP numbers? Unfortunately, economic data tends to respond with a lag. It tends to be slow to demonstrate the issue. And looking at the economic data tends to tell us where we have been as opposed to where we're going. So as we move forward week after week and month after month, the big ongoing question that we're looking to answer is, will the fear and uncertainty turn into actual economic problems? With that said, as always, we're going to do our best to watch the financial markets, read the economic reports, and study what we see in the data to bring you the best information in an easy to understand format so that you can stay up to speed on the markets. Thank you again for joining us this week. Don't forget to come back next week and check out our newest video, and we'll see you on the other side.